Okay, in this video, we're going to continue where we left off in the previous video. So in the first two scenarios, ABC purchased combined 30 widgets. Each widget was $100, right? There was no entry to XYZ because ABC was purchasing it and didn't do anything with XYZ. On the fifth, ABC sold 5 widgets to XYZ. It cost ABC $500 for those 5 widgets. They sold them for 150 each, so the selling price for those 5 widgets was 750. So XYZ now in its account has $750 in inventory. And they owe ABC $750, right? So when we look at the T accounts, we see accounts payable. Sorry, we see accounts receivable 750, sales revenue 750. We see accounts payable here 750 and inventory 750. Okay. All right. So that, and this represents 5 widgets. XYZ has 5 widgets that it purchased, and ABC sells 5 widgets. So now we have XYZ returns 1 widget to ABC company, right? Okay, so ABC has a generous return policy and XYZ returns one of the widgets. Okay, so now we need to really think about what's happening here. This is a return, and this is something that happens quite often. If you buy something, you return it to the store. If you don't like it, or maybe you change your mind, it could be many different reasons, and some stores have a more generous return policy than others, but what does that mean from a journal entry accounting standpoint? So let's think about ABC. What happened to ABC company here? So really what's happening is 1/5, the journal entry on January 5th and journal entry on January 7th is very similar, right? On January 5th, what happened? We went from inventory and we sold it, so it moved over to cost of goods sold. There was 5 items sitting in inventory. Those 5 items moved over to cost of goods sold. Well, 1 item is coming back, right? So 5 items went over, and then the customer said, hey, I'm going to give you back one. So where is that item going? It's going back into inventory, okay? So the 5 items went over to cost of goods sold because we sold them. 1 item is coming back. The key in this is that whenever you deal with inventory and cost of goods sold, you're always dealing with it at cost. And this is what trips people up, right? So for ABC company is going to deal, when it adjusts inventory, when it adjusts cost of goods sold, it has to do so at cost, all right? So let's look at this. So first, right, we said that ABC is going to receive an item back from XYZ company, right? So we're going to have to put it back into inventory, right? The item that took out, and we're going to take it out of cost of goods sold. Well, let's look up at on the January 5th. Here we have 5 items, okay, 5 widgets for $500. Each item cost $100, right? So if 1 item is coming back, then that's just going to be 100 out of the 500 because we took 5 widgets times 100, gave us $500. So we credited inventory for 500, we debited cost of goods sold for 500. Well, 100 of those items needs to go back into inventory. So what are we going to do? We're going to debit inventory for 100, right, to bring the $100 back, and we're going to credit cost of goods sold for 100 for the because that item wasn't sold anymore. It's not sold anymore, so we got to take it out of cost of goods sold and we've got to put it back in inventory. So basically we are reversing this. When we pulled it out of inventory, we debited it, we credited inventory, and we debited cost of goods sold. Now it's coming back, we're doing the opposite. And the key is this must be done at cost. When it goes back to inventory, you put it back in at cost, because when you took it out, you didn't take it out at the selling price, you took it out at the cost, right? So here you have to put it back in at the cost. So we debit inventory and we credit cost of goods sold. Okay, so now what happens to the sales? What happens to the sales? Well, since this is a return, is what we call a sales return, actually ABC, this has to be reduces my sales, because this is not a sale anymore, right? It's a return of sales. So let's look at the sales entry. When we sold this, we debited accounts receivable and we credited sales revenue, right? So we just basically need to do the opposite of this entry. That's what we did up here. We did the opposite of this entry, but not for 750, because 750 represents 5 widgets. We only had 1 widget returned, so we need to do the opposite of this entry for one widget. So we debited accounts receivable here for $750. We're going to credit accounts receivable on this side, but we're going to credit it for $150, right? Which is just the selling price of one. And again, I can't emphasize this enough. When we deal with inventory and cost of goods sold, we always deal at cost. When we deal with sales and accounts receivable, we deal with at the selling price. Okay, so we credit accounts receivable for $150, and then what do we do here? We should debit sales revenue, but in accounting, we don't debit sales revenue. We don't ever debit sales revenue. We debit a contra sales revenue account, which is sales returns and allowances. So every time you have a sales return or you have a sales allowance, instead of debiting sales, we debit this contra sales accounts with sales returns and allowances, and that allows us to track in a separate account exactly how many returns that we have, okay? So you debit sales returns and allowances, and you credit accounts receivable, all right? So we see that? So this is the return entry that ABC makes whenever there's a return. You first have to adjust the cost, you put it back into inventory, you have to put it back at cost, not the selling price, and you remove it out of cost of goods sold. And then you have to reduce your receivables because your customer is not going to pay you for something that they return, and then you put it in sales returns and allowances. So let's go ahead and journalize that. So over here for inventory, right, I am going to debit inventory for 100, okay, to put the item back in at the cost, right? And I'm going to credit cost of goods sold for 100. So this is my 100 here. Cost of goods sold comes down, inventory goes up because I put it back into inventory. I'm reversing that piece. And then my accounts receivable, right? I credit accounts receivable for 150 because I have to take this out of sales. My customer doesn't owe me for 5 widgets anymore. They only owe me for 4 widgets, okay? And instead of debiting sales, which would make sense, we debit this account, which is called sales returns and allowances. This is my contra sales account, okay? All right, and so that's it. So sales returns and allowances, 150 on the debit side, accounts receivable, 150 on the credit side. And then here, we have $100 in inventory, we put back in, and we took $100 out of cost of goods sold. So what is going to be the entry for now XYZ Company? What happens to XYZ Company? Well, let's take a look at what happened on the 5th. When XYZ purchased these items, they debited inventory for $750 and they credited accounts payable for $750. This represented 5 widgets, 5 items at $150. Well, now they gave back 1. So now, is inventory going to be $750? No. Inventory is going to be $750 less the 1 item that came out. And remember, what is XYZ's cost? XYZ cost is, each item for XYZ cost $150. Their cost is not 100, their cost is 150. So what are we going to do? We're just going to do the opposite of this entry here, right? Instead of debiting inventory, we're going to credit inventory, but we're going to credit inventory for the 1 item that we returned, which is the 150. And instead of crediting accounts payable, we're going to debit accounts payable for the 1 item that we returned, which is 150. Okay? Because we're not going to pay for the item that we return, so we have to reduce the accounts payable, and we have to pull this out of inventory because it's not an inventory anymore. So I'm going to go to inventory, and I'm going to put in 150 here. I'm going to put it on this side because we took it out, right? And then accounts payable, that's my debit, 150, okay? So I reduced the accounts payable from 750 minus 150 to 600. I reduced my inventory to 600. So this represents now 4 widgets. My inventory only has 4 widgets because each widget is $150. My accounts payable only reflects the amount I owe for 4 widgets, okay?